What is the correlation that matters to you right now, Subadra? What is the relationship not only in rates, but outside rates for you?
Well, I mean, everything is a correlated market, right? I mean, the bond yields are all very correlated. What's happening in Europe is definitely impacting what's happening in the U.S. Inflation is correlated. It's a global phenomena. But what we're really seeing right now is sort of a wreck in slow motion, if you will, where in the U.S. you're seeing the steady rise in inflation prints, the Fed acting aggressively as predicted, and then the very sharp inversion of the yield curve because of that. And the market's starting to price in a much higher probability of a recession, that leading to potentially, Fed funds rate peaking around 3.25 to 3.75%, and then cuts being priced in for next year. So this is all very much what you would expect would happen in a scenario like this where the Fed is very aggressive. As far as Europe is concerned and the ECB is concerned, they're in a much tougher spot. Like you pointed out, you're looking at very high inflation, headline inflation because of higher energy costs, higher oil prices, potential rationing. But then on the other hand, they have to be concerned about growth as well, because if there is a shutdown of Nord Stream 1, that's going to lead to a significantly sharp decline in growth. So policy then becomes a lot more tricky than it is in the U.S.
We need to be building up gas storage in Germany. Apparently right now we're working it down. This is really problematic. Subadra, more broadly for the bond market, I'm trying to work out what the anchor of global rates will be. Over the last 20 years, it was Japan, then it was Japan and the ECB and Europe and the bond market, and now there are doubts about the policy at the BOJ. Complete unknown when it comes to the European debt market. I've got no idea how you forecast European debt yields at the moment, Subadra. How do you come up with the Treasury call as you think about the global fixed income universe?
So to me, at this point, the anchor is the Treasury market, because things in the U.S. are much more predictable, like you pointed out, than in other jurisdictions. Bank of Japan, they have yield curve control, so in some respects, the long end is going to remain somewhat pegged, but there's a lot of pressure on the currency side of the equation. So at some point, they're going to have to, move away from the peg in Japan. So for me, what I'm really anchoring our rate forecast is on the 10-year and the trajectory for growth over the next couple of years. And that's really where I think that it's going to be very difficult for 10-year yields to rise meaningfully from here on, given the fact that growth is poised to slow down quite meaningfully over the next year, with the Fed expeditiously hiking rates over the next 3 to 6 months.
Subadra, let's take that a step further and build on what Bank of America did, where they downgraded their forecast for the yield of differential and the baseline yields for 10-year and 30-year treasuries at year end and even next year. How low, and have you been revising even lower your expectations for those yields based on the deteriorating macroeconomic backdrop?
So our view for treasuries is that 10-year yields will peak sometime in the second or third quarter. We might have already peaked. And then after that, we have a very steady trajectory of yields going lower from here on after the third quarter, perhaps ending around 2.25% to 2.5% by the middle of next year. So that's kind of the trajectory we're looking at. It is quite a dramatic move lower in yields from where we are right now. But it's all about the trajectory for growth after the Fed has addressed its raised rates and address the inflation problem, if you will.
How much is this also hinged on the idea that the Fed will not be able to shrink its balance sheet materially beyond perhaps just the middle of next year, because they will have to backtrack in the face of volatility, in the face of recession?
Yeah, that's a very good question, because the whole policy framework gets very, very tricky this time around, given the fact that after September, the Fed's balance sheet is going to decline at around $95 billion a month. So that's a very rapid pace of balance sheet unwind starting as early as September. So, I think my view is that the Fed might be able to raise rates maybe to get to 3.25%, 3.5% by the end of the year. But then you're going to see the balance sheet runoff act as a second order effect, tightening financial conditions as well. So it's yet to be seen if they're going to be able to continue to run off their balance sheet after the middle of next year, given the fact that they're going to potentially have to cut rates if the economy slows down meaningfully.